Thank you for coming. This is a real treat. I think that this is our first in-person Distinguished Speaker Series event since 2019. Yes. And I think you couldn't have asked for sort of a better set of people to be here. We have Booth alum David Booth, and of course, Booth alum and faculty member Eugene Fama here. And Anil Kashyap is going to moderate it. So this DSS, of course, this is a long-standing tradition. We bring in high-profile leaders from the government, from the business, from community to come in, share their insights and experience. And of course, once COVID hit, we launched the virtual DSS. And we've been doing it for the past couple of years. We began asking companies sort of how they were responding to COVID. But over the past year, this format has worked really well. And we've had lots of great people. Tom Ricketts from the Cubs, Jenny Scanlon, Dave McLennan from Cargill, Jose Antonio Alvarez from Santander, many, many others. But today is something very, very special and distinctive. So let me start with David. David, of course, needs no introduction, founder and executive chairman of Dimensional Fund Advisors. And David co-founded the firm based on the principles that he had learned at Chicago as a research assistant to Eugene Fama, which I'm sure we'll talk about. And Dimensional, of course, introduced the first small company fund based on efficient market principles, which was a very radical move at that time. And it's really stood the test of time, right? The company opened in 1981 and has grown into one of the largest fund managers in the United States today. David is a trustee of the University of Chicago and a lifetime member of the Council on Chicago Booth. So please thank David and welcome him here. The other side, we have Eugene Fama, the Robert McCormick Distinguished Service Professor of Finance. In addition to many, many honors, Eugene, of course, is the 2013 winner of the Nobel Prize in Economic Sciences. Eugene is widely recognized as the father of modern finance, one of the founders of the efficient market theory, focuses much of his work on the relationship between risk and return and the implications for portfolio management. Eugene got his MBA and his PhD from Chicago Booth and has been on the faculty here for over 50 years. So please welcome Eugene and thank him for being here. And my thanks to Anil Kashyap, the Stevens Distinguished Service Professor of Economics and Finance, for moderating the discussion today. Take it away, Anil. Thank you.
Thank you, Madhav.
Thanks.
All right, so let's dive in. I want to talk about a few things. Let's start with your early times at Chicago and kind of your principles for investing. So I'm curious what you guys remember about your initial impressions of each other.
Well, I'll answer for him because he thought my name was West. He kept calling me West the whole first semester,
So you met in his class?
Yeah, that was the first day that on campus. First class was Gene's.
Okay.
Yeah.
And what did you think of West?
We went through the class. It was a two-course sequence at that time. He took the two classes. He was clearly the best student in the class. So in those days, I took the best student, and they became my research assistant the next year. So that was him. And I think it was at the end of that year, he came to me and said, "I see what you do. I don't want to do it." He was a PhD student, so he said he was going to go out and actually get a job. And then I didn't hear from him for, how long was it? 10 years?
Yeah, about that, yeah.
10 years, and then he came back and said he was just starting a company. Said, "I want to be involved."
Okay.
That was the first time anybody had ever taken my courses, used my stuff, and said, "Do you want to be involved?"
Wow.
Well, in terms of first impression, though, I mean, I was 22 and he was 30, and he was this hot tennis player. Comes into class. I'm expecting, a big name, professor, and then walks this tennis player. I don't know what, something's missing here,
Like many of the faculty, I sat in on the class, and I viewed the class as kind of a religious event.
Yeah.
You remember one day he walks in, he says, "The great covariance matrix in the sky has opened, and down drops the returns." What do you remember from the class, if anything?
Well, one thing I remember was, I think you've noticed it gets cold in Chicago during the winter. And the first thing he would do, this was back in the they had the steam heat, and first thing he'd do, walk into class, he'd open the windows in the middle of the winter, you know. So you learned not to sit too close to the windows, you know.
Why?
Why did they open the windows? I don't remember. This was over in the math building that they was teaching this course at that time. So I think it was a little hot in that building.
All right. Well, okay. So let's go back to when you're thinking about starting the company. So what was it that you got out of here that led you to think that this business had a viable future?
Well,
maybe you should remind everybody what you were doing interim before you started.
okay, well, yeah, so as Gene mentioned, one day I walked into his office and said, I'm out of here. And so Gene calls up this guy named Mac McQuown at Wells Fargo. Mac was starting the first index portfolio, you know, and he wanted to get index funds going. And I went out and worked with him. And my group eventually got the indexing going, but they shut down my group because we irritated everybody too much. But we'd never at that time, the original concept they had was to do a levered S&P 500 fund. You know, for every $100 of client money, we'd buy $145 worth of stock and borrow 45. Well, indexing hadn't even got started. So here the first attempt was a levered index fund, selling to pension funds that typically can't use leverage. You know, it was complicated, and we ended up irritating everybody, and they shut us down. So what I got from that was we learned a lot about finance, but I hadn't learned enough about selling. And before we got to launch Dimensional, I went around and market tested the idea of a small cap index type portfolio. We're not straight indexing, but because at that time the only index funds were large cap index funds. So the idea was, well, why don't you have a small cap as well? And the idea went viral. They didn't use that term in those days, but so I go, holy cow, it looks like there's a business here. So and we're operating out of my apartment. My trading room was my converted spare bedroom, so it wasn't like we had a lot of resources here. So I called up Gene, and he picked up the phone. We chatted. It was like no time had passed at all. So I said, we want to start this firm, and we're going to need, up to the minute research, and why don't you head up the research activity and be a director? And he said, fine. And he's done all that, and he's actually been very focused on corporate governance. Over the years, it's a big deal with him. So we got that's.
So when you hadn't done a lot of work, as far as I know, on small cap at that point, right?
Well, we had two students who did the theses on small cap. He came up with the small cap idea before he even knew about these theses, but we had two students, PhD students, write their thesis on small cap stocks. And they had come up with the idea, not the idea, but the finding that the average returns were higher than you would have predicted with the CAP-M. So I told him that, but that had nothing to do with why he wanted to start this fund. He just thought the institutional investors didn't have access to small stocks. So
yeah, right. It was, fortunately, we sold it on the idea of diversification. You got to have large and small, rather than have all your money just in large. In 40 years, everybody gives you that one. But the reason I was saying was, we emphasized diversification benefit because shortly after we started, we went through this 7.5-year period where small stocks compounded at 2% and the S&P 500 compounded at 14% for 7.5 years. So that was the magic of diversification.
Lose on every one and make it up on volume.
Yeah, right.
So when you heard this pitch, what was your reaction as to?
Well, they had been among the academics. People didn't really believe that the small stock premium was achievable. They thought it would get eaten up in transactions costs, that you weren't taking proper account of how much it costs to trade these things. And I think Dimensional proved that wasn't true. That with slow trading, you could have the other side pay the transaction cost, basically.
And so you hypothesize that right from the beginning?
No.
Okay.
That was
So-
an empirical fact established
It was,
in the doing.
No, but the slow
was-
trading part. I mean,
Oh, no, that was his idea, I think.
Well, yeah, but it was there was a lot of skepticism.
Right.
We were all
Huge
skeptical.
skepticism.
I mean, in fact, we told clients we would underperform benchmarks because of trading costs. You know, and but at that time, indexing, people would trade through baskets. They would want a basket of stocks, market on close, which means they wanted to be guaranteed the closing price of a stock so they could track the index perfectly. We go, if everybody's trading at the same time, I don't think that's a good deal. That was my Econ 101 here coming through. So we said, well, we'll just trade differently. Of course, we had no experience, but nobody else did either. So, you know, it was a push.
And so you guys very quickly got to this point where you were following the strategy that you're more or less still following in terms of the trading strategies?
It was more or less, it's gotten much more sophisticated. I mean, I blush when I tell people the stories when managing the portfolio in the early days, but it's the same basic principle. We designed strategies around this notion of market efficiency, and you know, market efficiency doesn't say you want to trade mechanically. You know, that you don't want to go to the marketplace and be, you know, stupid. I mean, there is a role even in an efficient market for a little bit of judgment.
So
and
what
flexibility.
would be an example of that you would sign on to?
Well, you if you have a large block to trade and small stocks, you better trade it slowly rather than try to dump it in one block. So you're going to move prices with small stocks. So that's not particularly an inefficiency. It's just the cost of trading.
Well, and the other thing was the reason that the academics were saying you couldn't implement the small cap strategy was because they used simulated data and they had high turnover rates. Mm-hmm. So we go, well, what we'll do is we won't trade when something just goes out of the index. We'll let it run for a while, and then and so we sharply reduced turnover rates down to 20% or less, and that's what made it go.
Who else did you get involved at the beginning of this besides Gene?
Well, one day, so we decided we wanted to do a mutual fund because in those days, our initial portfolio was 300 stocks, which in those days, a portfolio with 300 stocks in it was administratively was a problem. So we wanted to commingle people into a mutual fund or a trust, something like that, and. So we're actually at a meeting in Gene's office, and the lawyer for you're going to use for the fund said, you have to have an independent board of directors for the mutual fund. I said, no kidding. So we were on.
That's the beginning of the corporate governance.
Yeah. So we walked. Rex Sinkfield and I, one of my partners, we walked over to the faculty building and walked into Merton Miller's office. They still teach Miller Modigliani?
Yeah.
Oh, yeah, good.
Taught it last night.
Okay.
In a macro class.
Oh, okay. Well, Merton walked in. Merton was the all-time one of everybody's favorites. Walked into his office and said, we need an independent board, and would you be on it? He said, sure. And walked out, and Myron Scholes was coming down the hall. Assume he'll teach Black Scholes. Myron, yada yada, sure. Now, and so then on. Eventually, those are the only people we knew were professors here. So, my roommate was Roger Ibbotson. I lived with him on campus for a year. Then eventually Jack Gould and George Constantinides, and now Abby Smith, and I'm going to leave out somebody. I'm drawing a blank here, but and the remarkable thing was none of them said, how much are we going to get paid? I talked to Gene and everybody. It was, and it didn't come up. Well, partly because we didn't have any money, but it was. It didn't. we were trying to do the right thing, trying to invest, consistent with the principles of what we learned here.
Okay, so you're getting all these people involved, and so what was this independent board doing? I mean, were they giving you any advice, or they were just standing back?
Well, they monitor. I mean, presumably they represent the shareholders of the mutual fund, and their job is to monitor us and make sure we're doing what we said we were doing, and of course we were. And it turns out we not only did we not underperform benchmark, small cap benchmarks, we've outperformed them. That first fund has outperformed its benchmark. I don't know why. This is not a sales pitch, so I can say it, but let's say it's like over 100 basis points a year for 40 years. So that difference in the magic of compounding makes a huge difference. So we were doing quite well. So it was incredibly stimulating, having this group of people coming out, monitoring results. And Merton Miller is particularly good at coining a phrase. Man, a lot of my phrases that I use still came from Merton. And Merton also chuckled, that we asked all these people to be on the board before they got their Nobel Prizes. So it was, and I think that was, going back to your original question, what was life? See, in 1969, when I was my first year, we were all a lot younger then. We kind of, the school was a lot smaller. Yeah. You kind of, PhD students and faculty kind of knew each other, and it was very. Look back on it, the people that were here then were really amazing.
Yeah, it's probably never. Well, it won't be surpassed. You're never going to have that kind of accumulation. But I mean, okay, so you've started. You're doing this index fund. You got this mutual fund. So what were the academic ideas that you brought to them subsequent to that?
Well, subsequent to that, I had been doing work on bond market stuff, and they started a couple of bond market funds based on that research. Those funds didn't attract a lot of attention until they got into the advisor end of the business, and then the advisors loved it. So that's one fund that's performed as predicted throughout its whole life. So.
Yeah, well, one reason it wasn't a big seller was that we called it the inflation hedge fund, because one of Gene's points was that
when short-term booming now, huh?
Yeah, but nobody was interested in inflation. I mean, we were past the peak in inflation, so maybe we'll have to bring back the name again.
Yeah, back and better than ever.
But then after that was in the 90s, the Fama French stuff was.
Yeah. So when did Ken get involved? So when
mid 80s.
So.
He was by 85 or 6, I think. We asked him, he had this paper basically saying the Japanese stocks were overpriced, and we were trying to get our international portfolios going in, and we invited him to present that paper. So here we are trying to get people to invest in Japan, and Ken's presenting a paper on it. Stuff. Ken always thought that was pretty cool. But that's Chicago, right? I mean, we want to be totally forthright to people. I mean, these are what the data show.
You know the story of that paper. It used to the working title was "Why Are Japanese Stocks So Expensive?" And then by the time it got published, it were so expensive. It was a pretty honest assessment. So, in terms of trying to take theory to practice, I mean, what are some of the things that you've observed? I mean, how has it shaped your views on?
Well, after it turned out that trading small stocks wasn't such a big idea, I never paid any attention to market microstructure after that because I thought it was all garbage. But
you haven't written a bunch of papers on that.
No, but the slip between theory, or not theory, but empirical work and actual implementation, it's a big jump, and day-to-day management of the portfolios is a big task. Much more difficult now than it was that we're big than it was when we were small. So the way things are done now is much more, not such complicated, but much more sophisticated than it was in the past. In the early days, people took the whole company home on the little floppy disks. Can't do that now.
You know, he glossed over casually. Oh yeah, well, Fama and French thing. I mean, it was the paper he was referring to was a cross-sectional of expected returns. It was a landmark paper that permanently sunk CAPM. You know, it was the period of the '80s was this period of anomaly research, and eventually it culminated with Fama French, the multi-factor model, which we use to create our value strategies.
So the company's not a small stock company by far anymore. I mean, you basically have stocks of all sizes all around the world, portfolios of all different kinds of stocks all around the world.
I mean, were you still reading papers at that time, or you were relying on these guys to tell you which ones to read? Or?
Yeah, I'd read the summary anyway. I mean, but look, you know,
an MBA.
One of the first things, yeah. One of the first things you focus on as running a firm is comparative advantage. And not everybody needs to do everything. And what's my comparative advantage was not in checking the Fama French research or so. I mean, they're and it's worked well. I mean, the academic connections, anything that's seems like a significant paper, then I do read it, but I don't.
Well, they did until the COVID struck. There were 2 seminars a year, at least, right, where all of the clients and prospective clients would come, and Ken and I would tell them which people to invite who were doing the current work, so they'd get to see the papers that were having impact at the moment. And
I know Gene was particularly special in that in those days you'd use overhead transparencies, you know, and he would get more numbers on a page on the overhead and our clients would sit there. I knew that I couldn't really follow what he was doing, so I knew they couldn't follow it. But by the time he was through, he totally persuaded them. I mean, and that's special.
Have you abandoned any ideas of stuff that they tried that didn't work?
I can't think of anything. Can you think of anything? Well, so let's put it this way. Ken and I, the way we work is we don't believe anything until we check it in multiple different ways. So, for example, the value premium, the first time we did it on data beginning in the 60s. And then we said, well, let's look at a sample. So we collected data going back to 1926. Then we collected international, we put it with the international data. So we check everything out pretty carefully before throwing it in. Now that doesn't mean you still can't come up with something spurious. You can. So the problem, though, is the reason I stopped when you said that is we're dealing with common stocks where the variances are enormous. So it takes basically forever before you can come to a conclusion that something isn't there anymore. That's the basic problem.
But it sounds like it didn't. It was more you guys following your research and then them trying it, than them coming to you and saying, "Oh, well, we've noticed this," or
no. It was always us. What David said from the very beginning was, "You guys do your work. We'll figure out if there's anything there we can use." But we said to him quite clearly, "We're not going to do our research oriented towards DFA or anybody else. We're going to do what we do. If you can use it, fine. If you can't, so what?"
I'll say it a little stronger. That Gene would occasionally come on and said before presenting the stuff to the clients, he'd say, "You know, I don't know if they're going to want to hear this." And I said, "Gene, tell them what you think. Spin control is my department." You know.
That's good. I mean, have there been others besides Gene and Ken that have played a similar role with you guys?
Well, I mean, let's talk about a different distribution.
Scale. Yeah.
Okay. Yeah, no, it's right. We have Robert Novi Marx.
Okay.
Our resident scientist right now is Bob Merton.
Okay.
You know, some people know Black-Scholes Merton. You know, or actually, that's what people know him for. But I share Gene's point of view, which is his amazing stuff he did was in this intertemporal capital asset pricing model. Mm-hmm. That's anyway.
So, I mean, also hired a bunch of our former PhD students, or I mean,
Right.
Robert was a faculty member here. I mean, do you have a pipeline where you're still bringing in people
Yeah.
with PhDs? And
Yeah, but you know, it's a funny thing. It's this notion of market efficiency is a pretty elusive concept for people. I don't know why. Rex Singfield, my original partner, I go, why did the two of us believe this stuff and nobody else seems to believe it? You know, and these PhD students coming out of major schools, so many of them want to go for a hedge fund and use, you know, use a quantitative model to identify market mispricing. I go,
With a
where did
T-stat
that
of
come from?
1.2.
yes.
But occasionally we find, and we have some great, our heads of research now are, you know, 2 PhDs from Chicago.
Is Marlena one of them?
Yeah, I
Yeah.
mean, right.
Yeah. So
Savino, so,
I mean, what do you tell people that are thinking about going to industry that are, you know, coming out of a PhD program?
yeah.
Say-
Well, those two were, Marlena and Savino were disappointments in terms of doing that because they had really good prospects academically, and they turned them down to go work for DFA. And you know as well as I do what the inputs are here when you
Yeah.
with a PhD student. So they get subsidized all along the way in terms of both cost and faculty, especially faculty time. So you want them to be kind of perpetuate you in a different way.
Well, I think we do a lot. We actually sell through education, you know, and the difference is, I tell Gene, is, you know, our job is to make sure the people we're selling to understand it enough so we could give them an A. You know, I mean, you know, getting a C is not an option, you know.
Yeah. Okay, let's change direction a little bit about some broader things. So in terms of building the business, a lot of our students, entrepreneurship's a big major here. So lots of people in this group are going to probably try to start their own business. Talk about some of the early decisions you made where you learned something or you do differently or approach differently.
Well, I think one of the things that hits you when you start here again, we were on a very tight budget. We operating out of my apartment. So you know, we couldn't, even if we wanted to hire expensive, I mean, really top talent, we couldn't afford, and we couldn't use them anyway. I mean, when you're a small primitive shop, you pretty much have to do everything kind of on your own. Mm-hmm. I wrote our code for our trading systems and stuff like that. I mean, you just kind of try to figure out how to do things as cleverly as you can, you know. And in those days, data were not as available, and so it was pretty primitive.
Okay, so you don't have some off the top.
Well, I'll tell you one thing that he did that is something you do if you're an entrepreneur and otherwise not. In the beginning, when we came up with the small stocks, it was a bad time for small stocks, but eventually it looked pretty good. The company was on firm footing, and we were doing really well. And the board was, David wanted to go into broader fields of investing, and the board, the outside people on the board who had been investors in the company, had helped the company survive, basically said, stick to your knitting. We don't want you to I remember that phrase,
Yeah,
right?
yeah, right.
Stick to your knitting. I don't want you to do that. And he just kind of ignored them. He and Rex ignored them and went on to bigger things, which was a big risk for the company to do it. But that's I don't know how you teach that in a class.
Well, here again,
How do you take risk?
you're right now, right. But I once gave a talk on things I learned in Econ 101 that I use every day, you know, and one of them is, you know, judge yourself by the quality of the decisions and not the outcome. So that's how you teach people to take risk, I think, a bit, or help them along the way, is say, look, not everything we do is going to work. But it doesn't mean it was a mistake. It just means it didn't work, you know. So.
I've heard you say one of the best things about dimensional is that the best argument wins. So can you say a little bit more about that and where that's mattered?
Well,
Or is it times when you've gone?
I mean, I think you're not digging deep enough there. it's not that the best argument wins, it's that there are arguments. So that there isn't a boss culture that people are afraid to talk to him or tell him what they think. That's not. Well, they see the way Ken and I talk to him. So
Yeah, I don't think anybody here thinks that Gene kowtowed to me.
I mean, are there
So
examples?
that's more like it's more like an academic atmosphere in the sense that you want people to question what you do, and you do everything in a positive way. So it's not an attack. It's actually trying to be helpful. And then I think you get some synergies that you wouldn't get with a boss kind of culture.
I mean, could you give an example of something where the process was solid and everything kind of made sense and then it didn't work out? Do you eventually abandon it, or did you come back to those things?
Yeah, well, I was thinking the other night about Merton Miller had this idea for real estate, to separate out, if you have an office building with triple net lease, you can really think of the people that own the building for the 30 years of the lease are the people that have leased it. And so you have then the period of time beyond 30 years. So instead of breaking it down to debt and equity, how about time-wise, slice ownership the first 30 years, then beyond 30. Elegant idea, yada, yada. We couldn't pull it off.
Well, we spent a lot of time, too, on retirement products that got shot out of the water by regulation, basically.
Yeah.
So what did you want to do?
I don't remember quite.
Well, no, it was Bob Merton had an idea for...
Right.
Basically, I won't try to explain Bob Merton, but it was a way of shifting around your asset mix over time to...
so more than a life cycle fund?
Basically simulated defined benefit plan.
Oh, I see.
Because companies were moving away from it.
Yeah. Anyway, we got down to the SEC, and they just didn't want us to do it. So they came up with some nonsense reasoning. But that's part of business that it's hard to teach, but a growing problem globally, not just in the U.S., is regulators that if they just don't want to do something, you're in trouble.
Yeah, so what are dimensions that you guys are still looking at? I mean, I think your company keeps evolving every time I look at it. So what are some of the things that are on the horizon?
Well, it's not until with Gene and Ken and so forth, the academics, it's been a lot about what we think of as the dimensions. I mean, even though we don't, in my view, a dimension is something we'll never know what it is. We have factor research that factors are probably linear combinations of dimensions, but or linear combinations of factors or dimensions. But anyway, what we're working on now in the last year, we've done a couple of things. One is, and I'm particularly excited about it, the smaller separately managed accounts. For years we've had separately managed accounts for clients in addition to mutual funds, but we had like a $20 million minimum. Well, administrative costs have plummeted, Moore's Law or whatever. It just so now starting last year, we came out with a way of investing with a $500,000 minimum, separately managed account. That's taken off like a rocket. And so it's very exciting.
So somebody comes in and you give them a quiz as to what your risk tolerance is?
No, we don't talk to them. This is a financial advisor. We work through financial advisors.
But what parameters do they give you to,
we have
make anything for them?
Actually, Savina and Marlena helped set up the software for all of this. So it's a pretty slick system. So it's kind of more like having a suit made. Do you want 3 buttons, pleats, and so it's do you want to exclude companies that are in energy, or do you want to exclude pharmaceuticals if you have a social
and
whatever?
When you need the money, how do you optimally take it out of the portfolio?
It's all equity, though?
It could be anything.
Fixed, yeah. It's been all equity. We're getting ready to do fixed. So,
That's great.
and tax loss harvesting,
Good.
that kind of stuff.
It's great. This is going to be like an exam question. Final exam. Like you got to figure out all these dimensions. That'd be super cool. All right. How about now for a lot of these students are probably wondering, what advice would you give them if you're sitting here at the beginning of your career and you're trying to,
Well, I don't give advice. Let's start with that. But
is that efficient?
No, I think that I don't think I have anything to add. I mean, I think you want to follow your passion, do something you think is, ethical and honest and legit, and so that when you get to be my age, you can look back and say, my career was worthwhile. I helped people out. I think you want to. It sounds corny, but having a bit of a public purpose is a good idea.
I mean, were there things that you did to navigate your way through courses here and early decisions you had to take in your career that, reinforced that or helped you? I mean, what were some of the? Okay, that's a good meta statement. Then how do you make that operational if you're starting out?
Well, I think you just keep your eyes open. Where's an avenue I can pursue that I can feel good about myself? For everybody it's different. I mean, and there are a lot of good people out there. I mean, I often stand up, I think, for business and say, yeah, there are probably a lot of crooks out there, and there are a lot of really, great people out there really trying to help improve people's lives.
So
I give the same advice to everybody. Find something you'll love to do, and make sure not too many other people want to do it. Don't be a ballerina. You didn't get a chance there.
Yeah, I think you need to. You can't zero in on a particular. Sometimes you can. I want to be a nurse or something, but often it's just in this general area. I think is a kind of firm I'd like to work with. My son just took a job. He is in music, and so he got a music label working with a heavy metal, which I don't relate to, but. So you ask him what he's going to do, and he doesn't really know. I mean, but he's in a firm, and they're the biggest in heavy metal, and so he'll figure out something.
how about just skills then that you would recommend in terms of hard skills, soft skills?
Well, I think this is the time to take hard skills. I mean, I took the. And actually, funny enough, I took the econometric sequence, and I don't know if it really helped me with anything in particular, but it did help me with the life lessons. The ability to understand uncertainty helps you go through life. Forget about investing, just dealing with uncertainty. It's a big deal.
I see.
Communication is important, really important. Well, you know it in our business. You spend more than half the time not actually doing the work, but figuring out how to convey it to other people. And one of David's saying was, every business is 50% marketing. And after my exposure to the business, I think that's on the low side.
Yeah.
So, but what do you tell students to learn how to be better communicators? So you just tell somebody grow taller.
It's like telling them to be smarter, You just can't do it.
Yeah. Well, it's amazing to watch. It's amazing to watch his generation go through. I mean, in the early years, a lot of your colleagues were really horrible in communicating. But then, and nearly all of them turned out to be good.
Yeah.
And Gene is, his background is really more in communication anyway, with Romance languages and so forth. And so he's really had a huge influence in the firm in that way as well, of just trying to be more precise with the language.
I see it now among the students. They're not as well prepared as they were a long time ago to be communicators. Most of them never wrote papers in college, so they never had somebody come and really tear apart what they wrote and show them how to do it better. And that's a really important skill that generations are missing because they don't do that anymore.
That's interesting. I mean, how much writing do you have to do in your marketing stuff? Is it Mostly face
Well,
to face, or
in the early years, I, along with actually one of Gene's sons, he and I did all the marketing material, because it's so fundamental and so important to be able to relate to the people you're selling to. I mean, I know that sounds pretty trite, but I mean, that's
I mean, what do you think was the most misunderstood thing or the most difficult thing to get across?
Well, the whole issue of market efficiency, the trick we had, if you call it a trick, was to get people excited about investing in a small cap efficient market strategy, and get them excited about the small cap and the diversification benefit, and not worry about so much that we weren't trying to pick winners. So he tried to stay away from that argument as long as you could.
I mean, I think it served you well during the financial crisis. I don't know what happened with you guys during March of 2020 and COVID and all that, but I mean, have you now, I mean, you've had, 40 years, so you must have had times when you've outperformed like crazy,
right,
from all of this. How do you avoid boasting about that?
Well, we have a lot of periods where we've really done miserably. I mean, and that's actually part of the story. I mean, the whole investment business, if you can keep clients when your numbers are very disappointing, and because everybody has those periods, and given the fact that you have fat tail distributions, they can last a little longer than you might think. If you can keep clients in the tough times, I mean, when your performance or when you're shooting the lights out, it's easy to get clients. And if you can hold them during the tough times, then you've got a solid business.
But you don't walk people in, right?
No.
There's no walk-up period or any of that kind of stuff.
Yeah, we just break their knees if they want to take their money. It's very subtle.
That's good. So I give the audience a warning here. At some point, we'll start taking questions from the audience. So there's instructions on where you go and how you vote to support questions that I'm going to pick from here in a second. So I think, one of the things that's remarkable is how many people have copied you guys now to some extent, or tried to copy you. What has made it hard for them to imitate?
Well, a track record is one. Also, nearly all the competitors, almost all of them, really say, what they do is they go, well, yeah, dimensional is pretty good, but here's our new piece of research that will be much better than what they have. And that's, some people, get hooked on that, and some don't, But we've pretty much towed the line on this whole market efficiency stuff. And at the end of the day, people know what you stand for. And if I would say it, going back to advice, be sure you stand for something, Whatever it is you stand for, don't be bashful. You'll get smacked around from time to time because you believe whatever it is you believe, but you got to stay true to yourself.
And in bad times, you don't get hit as hard because you never did promise to pick stocks. You promised to give them a segment of the market, and you deliver that segment. That segment doesn't do well. Nothing you can really do about that. Then their issue really is, do I still want that segment? And more often than not, they'll probably say yes. You had some bad times, but these are stocks after all.
Well, let me just say, I want to make sure I get this in, that I just hope, I won't give advice, but here's my hope for everybody here, which is, here I am 51 years out of my MBA, and I still believe in the same principles, the core beliefs that I came out of school with, I still believe in. I just hope all of you can be able to say the same thing, and that I feel really, I think I came out of here with a public purpose even, that we can change the world, we can make things better. And we're part of the vanguard of people that have done that. It's not just us, but, people are investing, they're getting much better deals in investing now than they did 50 years ago. Lower fees, more sensible products, safer products. So anyway, that's my hope.
Has any of the evolution of financial markets ever forced you to think that you're facing some sort of fundamental risk that things were just going to get eaten away, or that the business would cease to be viable?
No, back in the financial crisis, for a while there, I think we were all worried that will the ATM machines work? I don't know what would have happened if. But
Ken told me, how many primary brokers did you have before that?
Yeah, I don't know. All right.
More than Lehman, I guess.
Yeah.
All right, so I'm going to start taking a few of these questions. Okay, this one I think I know the answer, but I'll ask. It's got the most votes. Do Nobel laureates have any casual get-togethers or group chats?
To who?
Nobel laureates.
Oh, casual. Yeah, I have them with Thaler all the time.
Thought you were going to say the faculty lounge, but
We haven't been in the faculty lounge for 2 years.
yeah. Okay. All right. What do you think the most positive things that MBAs could do to, improve the world, or, go into society? Do you have a view on a direction? I mean, you've kind of given a principle, but I'm curious.
So see, I approach it slightly differently. That for most people in the world, the part of the biggest value they can create is just take a job. I mean, my parents were that way. They never made any money, but they, worked hard, did their job, raised a family. I mean, socially, that's about as good as it gets. So.
I'll repeat what I said. You're going to spend a third of your life, 1/3 sleeping, 1/3 working at least. You better find something you love to do. And then not many other people want to do it.
Okay, this is a good one.
But that's a matter of taste in the end, right? It's not.
Okay, this is a good one. I know what he's going to say, but I'm here. So when GameStop was going crazy, there was a faculty lunch one day, and Gene and I and 2 other faculty were there, and I kept screaming, "Gene, it's a hockey stick. Look at this thing. What do you make of this?" And not answering for a while. 2 days later, the thing's crashing. All of a sudden, he starts answering. He starts group reply all. Look at this.
Market efficiency is a model. You don't call it a model if you think it's 100% reality. There are things that are going to be inefficient. That was certainly one of them. That's why you basically don't want to get in the business of picking stocks. Diversification protects you against things like that.
When all that was going on, did you guys...
Well, what happened was, it was in our small cap portfolio, and so then it took off, and we were able then to justify selling it at a really high price because it was no longer a small cap stock. So,
I'm really suspicious of Bitcoin. I think that's a bad one.
It's kind of a miracle that crypto didn't get the top vote. Maybe we've passed peak. I mean, there was a question about what do you think of fintech and crypto and all of that. Do you think it's going to?
Well, if you think back to monetary theory says Bitcoin shouldn't survive as a means of exchange because the real price is too variable.
Yeah.
And it should go. And even the crooks that use it to do exchanges don't want to hold it. They want to get rid of it quickly. So it shouldn't survive as a means of exchange.
Yeah.
So if its value is just based on belief in something that you don't know about, eventually you expect it to crash.
So what would it take for Dimensional to conclude that crypto is an asset class in which you'd offer a product?
Convince Gene.
Okay, that's not happening. Here's one about how the school's changed. I don't know how much. Well, okay, let's go first.
Yeah.
How the school changed?
If you want to go, so I joined I came as a student in 1960,
Right.
and joined the faculty in '63, and at that point, basically, finance didn't exist. It was just getting started. It was MERT against the world, and then I came on. The only strong area was economics, basically, and accounting. So accounting was pretty good because there really wasn't any academic accounting, but the faculty was pretty good. Marketing was awful. Most of the other areas were awful, but not because we were worse than everybody else, but because it was awful everywhere. And then the Ford Foundation came along and threw money at business schools and said, become real academic institutions. Now in Chicago leaped at it and slowly developed outstanding faculties in every area. So what I say now is, we're really good from a research standpoint and from a teaching standpoint in every area. Whatever you want to say, marketing or whatever. Finance, obviously, but in economics, obviously. But every other area as well. There are really no weak areas in the school like there were in those days. I remember when I came, I went to Joel Siegel was the director of the doctoral program, and I said to him, I wanted to get into the doctoral program. And he said, well, you better wait a quarter because graduate school is a lot different from undergraduate school. And I went back to him at the end of the quarter and I said, yeah, it's a lot easier. Because the classes at Tufts and the students were much better than the classes and the students here. So I immediately started taking courses in the economics department.
That's great. So, I mean, maybe you can reflect on this in two ways. I mean, first, just you've been recruiting here for a long, long time and how you see that. And I'd be curious if you could say something about whether you understand how transformational your gift has been to the school. I could say something about that in a minute, but I'm just curious. So in terms of recruiting for a long, long time, how have things changed?
Well, I mean, everybody, I think the students are just much more sophisticated. I mean, I think, we find a lot more people with good technical skills and that make good presentation skills, actually. I mean, it's a little different than Gene, I guess, may have found, but it's just the overall quality has gotten better all the time. We were just a bunch of nerds. I mean, I'm coming now and speak for myself. I don't know why anybody would have hired us, but now it's...
The bottom level of the MBA program is way better now than it was in the 60s or 70s. No, I mean, really, the admission rates were much higher relative to the quality of the students coming in. Now that's not the case anymore.
I mean, I don't know what you hear or what you think about how the gift has changed this place. I can give you two examples. I mean, almost all of our competitors had hiring freezes right after you gave them money. And so we made hay. I mean, we hired a bunch of great people those few years, and we retained everybody, which was huge. And now, if you look at what the faculty recruiting is like, I mean, Gene and I want to be reborn as assistant professors, given how much they teach. So the ability to keep hiring this gift is game-changing. I've had deans at other schools tell me that, Chicago will be there when, it's the nuclear bombs hit, it's cockroaches, there's only 2 business schools left. Chicago will be one of them because of this gift. So I don't know if you can appreciate how much the faculty sees it, but I don't know what you see.
Well, one thing I see is that people like you come up to me all the time when I'm walking around, see me around here and come up and shake my hand. That means a lot, I appreciate that.
Shake your hand right now.
Yeah. No, when I started thinking about what I want to do, I think you understand now how much I owed this school. The stories about Gene and all the other faculty that helped over the years. And I wanted to give a big chunk of what I had. And I started thinking back, one of the things about Chicago was I thought they had the best faculty and one of the skinniest endowments relative to the competitors. So my gift, which is basically unrestricted, I said I wanted mainly for faculty support in a way that you wouldn't go through your normal budgeting process. This is mad money, if you will, and just do with it what you want, but make sure you have a great faculty. And so I think you have a great faculty. I mean, Madhav keeps me posted. He's so pleased with the faculty, and Gene very pleased with the faculty. I mean, makes me feel good.
That's great. I mean, there is a question here. Tell us what you think Dean Raja is like. I've never met him. Not me.
Well, I think he's absolutely fantastic. I mean, I really do. It's funny enough. I got to meet him actually out at Stanford. I wasn't. My daughter went to got her MBA there, and so she knew about Madhav coming here before it was widely known.
Okay, that's great. Let me take one more, and then we'll do some parting thoughts. When you have to go, okay, well, I'm going to go down to two. In terms of research that you see that's underway now that you think will end up being relevant for their business, do you have a bet or a view?
I think we're in a slow period actually for asset pricing research. It's kind of, the factor revolution is kind of over. People are sick of that. And basically now in the finance workshop, I think I said it to you, you see a lot of papers that don't seem to be in finance really. So I think that we're in a period of kind of slow cogitation about which direction the field is going to go. I don't know. I don't know the answer to that. I'm working on real estate at the moment, so.
That's good. Okay, the last question, and then we'll head out here, is what do you think of Elon Musk buying Twitter?
Well,
you on Twitter?
I don't know Twitter. I don't tweet. I'm not on social media. I mean, so I'm a bad person. But let me. One of my favorite things, though, is I think people like Elon Musk should be celebrated. Too often, and among politicians and whatnot, business people get blasted for this or that. I mean, I don't know. I'm not saying anything. I don't know Elon, and he has an unusual personality, I gather, and. And look what he's done. I mean, people like, Jeff Bezos. I mean, okay, these are unusual characters. It takes an unusual character to make $100 billion, these are not normal people.
There is no marketing study that says positively that advertising on the internet generates revenues. So if that ever gets established, what happens to all that stuff?
Okay, that's good. Maybe that's a hot take to leave. All right. So, all right. Well, thank you so much for being here. We're going to now adjourn through the Winter Garden. Madhav will be down there, and we're going to unveil the bust of you in like 2 minutes. There'll be a champagne toast. So please join me in thanking Gene and David.